Well, really, the key question that investors have to ask about the recent deviation of the yuan is, what does it mean and what does it indicate? Now, for a long period of time, we've been talking about the macro risks for the Chinese economy, given the fact that they have weak demographics, they have waning productivity growth, urbanisation 75% complete, they have a massive debt burden, they have the second highest real interest rates in the emerging markets, and they've had a massive currency appreciation, both in nominal and real terms. So to us, that really signalled that there was much more downside risk to China than probably what the market was appreciating. And I think the PBOC's change in policy in mid-August, what that really signals is that they agree that those combination of factors are just too big a hurdle and that they need to introduce a much more dynamic stimulus to the Chinese economy. So what it really means, they're going to have to cut interest rates, they're going to have targeted fiscal spending, and in the end, investors are going to have to factor this into their portfolios. The biggest risk globally to me in the next 3 months is going to be the battle between those believing in global reflation and those believing in global recession. Now, in the past 18 months, markets have been very much supported by the global reflation trade, improving growth in the US, Europe and Japan. In the scheme of things though, this all risks being swamped by a much more dangerous downturn in global emerging markets. So to me, these themes are going to be crisscrossing consistently over the next 3 months at a time when the US Fed might also be raising official interest rates. And to me, this is really going to set the scene probably for the next year. So in the scheme of things, I tend to think volatility is going to pick up, rates of returns are going to come down, so investors need to make sure that their portfolios are based on assets which not only have attractive valuations, but also, most importantly, have very strong balance sheets. Because in the end, strong balance sheets are the easiest and by far the best form of risk management. You tend to get a pretty wide reaction to US Fed tightening cycles. Now in 1994 there were pretty big losses in both the equity and the bond market. 2004, the equity market rallied pretty strongly through it. And that's because the rate hikes were very well telegraphed. Now, we're not seeing a lot of massive downside risk from US equity markets solely from the US Fed. In the scheme of things, traditionally, Fed rate hikes, the first one at least, leaves a lot of upside still for earnings growth and price growth. But by the same token, valuations are starting this tightening cycle at a much higher level than is traditionally the case. So in the scheme of things, I tend to think you might get a very slow grind in US equities at best. But the good thing is I don't think there's a lot of downside risk for the US bond market. What's going to happen is that, of course, the shorter end of the curve is going to increase in line with the US Fed, but inflationary expectations are being downgraded given the trends in energy prices. So I think what we're going to get really is a yield curve flattening trade, a little bit of upside maybe in equities. Well, if you look at both equity and bond markets at a holistic level, you tend to think, well, there's not a lot of valuation upside, and indeed rates of return from here are going to be pretty modest. But I tend to think that what investors have to do at this stage of the cycle, because this is a very unique cycle, is they have to try to get away from the trend of the market and start to look at the trend within the market. So in the risk markets, where I like opportunities, in the markets which have attractive valuations with earnings upside, and I think of particularly there both Japan and Europe. I don't really like the outlook, for example, for the United States. I also think there is some opportunities at the opportunistic level in global credit markets. Now, spreads are increasing, which gives you a better entrance point. The key thing here, though, is really your stock selection. So I tend to think there may be some more upside risk there, particularly if volatility in the emerging markets increases. But in the end, if you can get those credit securities at an attractive valuation, then that will be a very good long-term investment to have in your portfolio.